So you want to start investing in the stock market. That's awesome. But are you saying to yourself,
I don't know about stocks.
How do I choose the right companies?
I don't know how to analyze financial charts.
I'm not an investment expert.
What if the stock I choose crashes?
What if the company goes bankrupt?
well, have no fear. That's why I'm here, to help clear the way with a solution that helps get rid of all this noise. An option that's so simple, even a beginner can do it. And in fact, most beginner investors do. So stick around as we peel back the onion on one of the easiest and safer ways to invest in the stock market. Hey everyone, this is AJ, your ace in the hole, and welcome to the channel where we simplify personal finance, providing tips for young adults, parents, and anyone else looking for some financial insight. And sometimes we take a deeper look into one of the most popular investment options you must know about, especially if you're new to investing, and that is the ETF. And if this sounds interesting, please take a quick second to click the like and subscribe button to check out lots of future content just like this. Now for starters, what is an ETF? ETFs, or exchange traded funds, are a collection of investments, usually company stocks, grouped together, offering investors the ability to purchase individual shares of a single fund, investing in numerous stocks or investments with a single purchase. Now, what does that all mean, you might ask? Think of a burrito, where all the fillings are individual company stocks, while the tortilla is the ETF. Or a pizza, where you could buy the individual ingredients, the stocks, or just purchase the finished pizza, the ETF. Now, before I get any hungrier, here's a list of all the topics I'll be covering, and by the end of this video, you'll know all the basics about ETF investing. So if this is of interest, then sit back and relax, because we have a lot to cover. Let's start off with a quick history. The first ETF was launched in Canada in 1990, which tracked the Toronto Stock Exchange 35 index. The first US ETF a few years later in 1993, which tracked the S&P 500 index, ticker symbol SPY, which to this day is still one of the largest ETFs. Now, as I mentioned, ETFs contain a grouping, or as many refer to them, a basket of investments, typically company stocks, but can include bonds and other commodities such as gold and silver. Instead of buying individual stocks one by one, you can purchase a single ETF and share in the performance of numerous companies. This is at the core of what makes ETFs such a powerful investment tool, which leads me to the next segment, the benefits of ETF investing. The most obvious benefit is the ability to acquire numerous investments all at once. One of the biggest concerns of investing is risk, and ETFs provide a solution to help with that. Investing in a single stock is risky, as your investment is fully dependent upon the performance of a single company. Now, you could spread the risk by investing in many single companies one by one, but that requires multiple transactions, complexity, and can require much more money to do so. Or you can simply purchase shares of a single ETF and get the same result, and at a lower cost, which is perfect for new investors. Another benefit of ETFs is that they usually have much lower fees compared to other types of funds, and I'll touch on why in just a bit. ETFs can also be bought and sold very easily, just like stocks, at any time throughout the day, using all the common stock trading features such as limit orders and even pre-market trading. Now, since I touched on it, let's talk about those low ETF fees. The majority of ETFs are passively managed, meaning there's little to no ongoing maintenance of the fund, as opposed to other types of funds that are actively managed, which I'll elaborate more in just a bit. Fees, or expense ratios, for passively managed ETFs can average as low as 0.03%, which equates to only 30 cents for every $1,000 invested annually. Next, let's look at the various types of ETFs. In short, there are ETFs for just about anything you can think of. There are ETFs that invest in broad market indexes, such as the S&P 500, the NASDAQ, and even the total US stock market. There are sector ETFs that allow investment across specific industries such as tech, healthcare, energy, and real estate. Thematic ETFs invest in specific topics such as clean energy, AI, robotics, or cybersecurity, and low-risk options such as bond and fixed income ETFs that invest in government, corporate, short, and long-term bonds and treasuries. Commodity ETFs allow investment in things such as gold, silver, and oil, and international ETFs that invest in developed and emerging markets. It's reported that in 2025, over 4,100 ETFs are now available in the US. So as I said earlier, if you can think of it, there's probably an ETF for you. Now, you might be wondering, with so many options available, how in the world do you go about choosing which ETFs to invest? And that would be a very valid question, as there are some factors to consider, including the companies or holdings within the ETF, the historical performance of the fund, and the expense ratios, or the fees. The other thing to consider if purchasing more than one ETF is fund overlap, or the level of commonality between funds. And don't worry, there are many free websites that help with all of this research. In fact, let's look at a quick example of how you might choose an ETF. Let's say you're interested in investing in the company Coca-Cola. One way to begin is using an ETF stock exposure tool. These provide a listing of all ETFs that contain a particular stock and its associated weight within the ETF, meaning how much of the fund is allocated to that stock. From there, you might research a few different ETFs that contain your targeted stock, assess each fund's performance, and maybe even see what other stock holdings are included. For example, you might also want to invest in Apple stock, so you could search for an ETF that contains both companies. Now, let's take a quick look under the hood at 3 of the most popular ETFs, which might provide another good place to start. First up is the largest and most widely held ETF, the Vanguard S&P 500 ETF, ticker symbol VOO. This ETF mirrors the S&P 500 index, which tracks the largest 500 U.S. companies with the top 15 holdings shown here. Next, we have the Invesco QQQ Trust ETF, ticker symbol, you guessed it, QQQ. This ETF is designed to track the NASDAQ index, which consists of the largest 100 non-financial companies on the NASDAQ exchange, spanning a wide array of industries like technology, healthcare, and consumer staples, with the top 15 companies shown here. And finally, there's the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. This ETF provides exposure to 100 of the top dividend-paying U.S. company stocks, providing the opportunity to earn money in addition to the stock holdings. SCHD provides a vast array of companies, with the top 15 shown here. Dividend ETFs provide a cash payout, typically quarterly, for as long as you own your shares. You can either take a cash deposit or reinvest into more shares, known as a dividend reinvestment plan, or DRIP for short. For an even deeper dive into how dividend stocks work, check out my video on basic stock investing, which I link below. Now let's look at how to assess fund overlap to ensure you remain diversified when purchasing multiple ETFs. The ETF Research Center offers a free fund overlap tool to compare. For example, comparing the VOO ETF to the QQQ ETF results in a 52% stock overlap by weight, yet when comparing VOO to SCHD, there's only a 7% overlap. These are the type of things you should consider when investing in multiple ETFs. While there's usually some level of overlap between ETFs, the less overlap the better as it relates to diversifying your investments. On the contrary, there's also a strategy known as portfolio tilt. In this case, you intentionally look for funds that overlap to some degree. Let's say you purchase one ETF that has 15% of its holding in tech stocks, and one completely different ETF that has 20% of its holdings also in the tech sector. The two ETFs together still create diversification, yet leans or tilts more heavily towards the tech sector collectively. Keep in mind, this also leans your risk a little more towards the tech sector as well. Let me know in the comments if this makes sense. One of the easiest ways to buy an ETF is through any of the popular investment firms using a standard brokerage account. Simply open an account, deposit funds, and start investing. You can also buy ETFs within other types of accounts, such as traditional or Roth IRAs, or even in an HSA. I have videos on each of these types of accounts, which I've linked in the description below, along with all the ETF websites we're using here. And remember, always do your own research, or reach out to an investment professional before purchasing any investment, including ETFs. Now, let's briefly cover how ETFs compare to other investments. First up is ETFs versus individual stocks. ETFs allow you to diversify across hundreds, even thousands of stocks with a single purchase, versus buying those stocks one at a time. Now, one important difference is when purchasing individual stocks, you effectively own shares of that company, meaning you even have shareholder voting rights to vote on things such as board of directors, company acquisitions, and other proposals. With ETFs, however, you own shares of the ETF and are not a direct shareholder of each company, despite still enjoying their stock performance. ETFs compared to mutual funds are similar in that they both contain a mixture of stocks. However, a key difference is that mutual funds are actively managed by investment professionals to ensure very specific fund characteristics are maintained. This creates additional costs that are passed on to shareholders, creating higher fees than passively managed ETFs. Another key difference is that ETFs can be traded at varying prices throughout the day, just like individual stocks, whereas mutual funds are only traded at the daily market closing price. Also, mutual funds can require a minimum investment amount, commonly $1,000 or more, while you can purchase a single share of an ETF if you choose. Now, how do you know if ETFs are the right investment for you? ETFs are a good fit if you don't like picking individual stocks, you want a simple way to diversify your investments to reduce risk, and you prefer low-cost options with stock-like flexibility. ETFs may not be a good fit if you want to ensure you have company voting rights, you enjoy individual stock trading, and you're okay with accepting end-of-day pricing. In the end, regardless of your investment strategy, ETFs likely have a place in your portfolio. They provide a simplistic approach that checks off so many of the boxes as it relates to investing, making it easy and cost-effective for both beginners and experienced investors. That said, I really hope you found this video helpful, and if so, let me know your thoughts in the comments. Do you think you might pursue ETF investing, or are you not quite sold on the approach? Or do you already invest in ETFs? Now, before you go, if you haven't, be sure to like and subscribe as it helps push the video to others that might also find it useful. And as a reminder, if you enjoyed this video, be sure to check out my stock market basics video here. And remember, it's not how much you save, it's how early you start. This is AJ, your ace in the hole. See ya.